In a surprise move, the Federal Reserve released the results of the latest round of stress tests 2 days earlier than expected. 15 of the largest banks fared well, while 4 of the banks, Citigroup, Ally, MetLife, and SunTrust, failed at least one scenario of the Fed's test. Joining us now to talk about all this is Breakingviews U.S. Editor Rob Cox. So, Rob, before we get into the details, did Jamie Dimon force the Fed's hand by announcing a dividend
I don't
increase
think
earlier?
so. I think he basically the Fed is a really funny establishment, and so everyone was expecting Thursday, but they never came out and said they were going to do it Thursday. So they came out, surprise! Here's the data dump. Go ahead and let your shareholders know what you'd like to tell them about the capital repurchases and whatever you're going to do. I don't think there was any particular I don't think Jamie forced the Fed's hand, but it is curious. I mean, it just reaffirms the sort of oddness of the Federal Reserve from my perspective. That said, the results, it's great to have them out there.
Well, these results, we should back up a little bit. Basically, a stress test is you throw all the worst case scenarios at a bank and ask, is there going to be enough money if something happens? So the Fed says most of them fared well. Well, you have 4 that obviously did not. A bank like Citigroup, are we still at risk for a global financial meltdown if a bank like Citigroup would not have the capital needed?
Well, I mean, this was a pretty severe scenario. They tested. We're looking at a 50% decline in the stock market, a 13% unemployment. I mean, quite a bit. I mean, again, we did have situation like that, 3 years ago. So it's the right thing to do. But I don't think. I mean, what they said was you're basically down by whatever 50 billion or something of capital that need to be accounted for. So that's what the banks are going to have to do. They're going to have to retain a certain amount of earnings. Citigroup's not going to be able to put out a dividend in the same way that J.P. Morgan has. Ally Financial is not anywhere near going to be able to do that. And likewise, MetLife or SunTrust. I mean, so what they're basically saying is you need to preserve capital. You can't start to spend it on share buybacks. You can't do deals. You can't spend it on dividends until you gotten to the point where, under these scenarios, there's a couple of different metrics they look at, but basically your capital ratios would not blink below 5%.
Do investors beat up on those 4 stocks?
They are, sure. Bank of America too. I mean, look, this is the great thing about it. It's sort of capitalism at its finest, free market capitalism. You have transparency and disclosure, and you can separate the sheep from the goats in the American banking and financial industry. That's a good thing. We can see what happens in these scenarios. Investors can go out there and go, okay, Jamie Dimon, man, that guy's running a bank. I want to own that bank. I don't mind paying 1 times book value for it. I don't know about Citigroup. I've got my concerns, this kind of thing. And that's exactly the way it should be. And we're in a situation now where, unlike, say, 3 years ago, where there was total concern about confidence in the banking system, that you couldn't quite separate the sheep and the goats. You had to sort of, remember the whole TARP process was about everybody gets to jump in, even though Wells Fargo and J.P. Morgan were nowhere near in a situation like Citigroup or Bank of America at the time, but they all had to take the money. Now you're not in that situation, and the markets can basically handle the truth, as it were.
But how much pressure will the leadership of Citigroup and even Bank of America remain under? What do they have to do? Well, they can't go out and buy things and up their dividends. What do they do at this point?
Well, Vikram Pandit at Citigroup is basically going to have to, we argued today, one of the things he's going to have to do is accelerate the sale of Smith Barney to Morgan Stanley, which will help release another $10 billion in capital, because they have to hold capital against equity investments. He's going to have to, I don't think he's necessarily going to have to do any distressed fire sale of any sort. I mean, one of the big problem assets, they've already ring-fenced them and put them into Citi Holdings. Those are the things they've got to, over time, get rid of, and they are getting rid of those over time. But he's not going to be able to pay out a dividend like he had hoped to. Bank of America, same thing. They're just not going to be able to please their shareholders. And as the consequence of that, of course, is going to mean that they're not going to get the payouts. Their people are not going to get paid out because they're just not going to be making the money. I mean, they're not going to be able to pay dividends, for instance. And that's a motivating factor for them to preserve capital and get their capital ratios back up.
So it's a bit of a financial free-for-all for everyone who passed, right? We're seeing dividend increases, buybacks. I mean, how much of this is going to continue?
Well, I'm not sure it's a free-for-all. I mean, they're getting some of the things they asked for. So Jamie Dimon asked to put the dividend up, quarterly dividend up to 30 cents. He might have asked for the 15 billion repurchase, which is what they had the last time. The last time the Fed did this exercise. And by the way, the last time the Fed did this exercise, it didn't come out with anywhere near the disclosure it came out with today. This is more akin to what we got way back, I think it was May 2009, which was the original stress test, which I would argue was the defining moment when the crisis arguably, was able to sort of end and we were able to move on.
We've seen a lot of interest in financial stocks, and they've obviously rebounded quite a bit as the market has rallied. Bottom line, should investors feel assured, and does the smart money look even smarter?
Look, I mean, if you were able to pick through the goats and the sheep here, absolutely, and I think you can see investors have been doing so over the last couple of just the beginning of this year. I mean, since the beginning of the year, there's been a huge run in a lot of these bank stocks. So Goldman Sachs, when it was trading at $100 a share, which is well below its book value of $130, 130, that was a screaming buy if you believe that Goldman Sachs was money good. And I think that these stress tests are basically going to show that. And likewise, even with Morgan Stanley, though Morgan Stanley's not quite, hasn't had quite the rally that Goldman Sachs has, and still trading at a much bigger discount to book value. Basically, people of the smart money got in at the right time.
Rob Cox, Breakingviews U.S. editor. Good to see you, Rob.
My pleasure.
I'm Rhonda Schaffler. This is Reuters.